There is a good chance something reached your door this week under 10 minutes. A packet of milk, a phone charger, a tube of ice cream, close to midnight. The company that bought it is about to do something rare. It's going to ask the public, you, to help pay for it. And inside the 600-page document it filed with the regulator, there is one number. The headlines are not reading to you. Last year, on every single order it delivered, Zepto lost money. Not a little. By its own filings, the operating loss worked out roughly 79 rupees an order. That's improved from 136 a year before. But it's still a loss. And it now runs about 2.3 million orders a day. So this is not a story about whether 10-minute delivery works. It clearly works. It's a story about who had been paying for it and who is being asked to pay next. This is the part of the Zepto IPO that doesn't fit in a headline. Start with what is true. Zepto was built in 2021 by two Stanford dropouts who bet that the future of Indian retail was not bigger supermarkets. It was thousands of tiny warehouses hidden inside your neighborhood that you had never walked into. They call them the dark stores. In 4 years, the network grew from few hundred to over 1100 across 60 cities. Revenue went from about 4,500 crores to over 22,000 crores in just 2 years. It became a word people use as a verb. And now it wants to list India's first pure quick commerce IPO. Here is the thing to hold on to. Most companies go public from a position of strength. Watch closely because Zepto may be going to public for a different reason. Let's lay out the bull case fairly because it's real. Right? The growth is not a mirage. Revenue doubled. Orders crossed 64 crore in last 1 year. And the economics are genuinely improving. Pack stores close enough together and the rider travels under 2 kilometers an order. So each delivery cost less. The loss per order fell. And the gross margins widened from under 13% to over 18%. There is even a second engine forming. And it's the clever part. The advertising business, brands paying to sit at the top of your search, grew many times over. That's the Amazon playbook. Quietly turn a marketplace into an ad platform. If you stop the analysis here, it's a clean growth story, and most coverage stops here. Now, the one number the growth story can't explain. While the loss per order was shrinking, the loss got bigger. From about 4,700 crore to 5,900 crore in single year. Sit with that. Each order become less unprofitable and the company lost more money overall. How? Because every order still loses money. So more orders means more total loss. You are not climbing out of the hole faster. Then you are digging it. It's the Kirana shopkeeper who cuts his loss per sale, but sells to twice as many people on credit and ends the month deeper in the red. And the company's own document is honest about the risk. It states in plain language that there is no assurance its spending will translate into higher revenue later. Read that carefully. That's the business telling you the operating leverage everyone assumes. Sell more, magically, profit is not promised. So, this is not a machine that's been switched to profit. It's a machine that loses little less on each unit while scaling the units very fast. So, here is how the machine actually works and who has been holding it up to. Truth 1. You cannot make money delivering 50 rupee packets of milk in 10 minutes on the delivery fee alone. The fee doesn't cover the rider, the store, the packaging, the tech. So the business was never really about the milk. It runs on two hidden engines. Densification to shrink the cost, and advertising to add high margin layer on top. The grocery app is slowly becoming an ad company that happens to deliver groceries. Truth 2. Until now, that 79 rupees gap on each order has been filled by someone, not you, not the banks, venture capitals. Roughly $1.8 billion raised over the years, paying down the difference between what the service cost and what you pay. The company has run negative operating cash flow since it began. That's not an accident. It's the business model. And here is the tell most people miss. Look at what the IPO money is for. Part of it is going to expanding the dark stores. Fine, that's a growth. But the part of it is earmarked to pay the lease rentals on the dark store that already exists. You don't raise fresh equity from the public to pay rent on shops you're already running, unless the cash coming in the door is not comfortably covering the cash going out. Which brings us to the clock. By one major brokerage estimate, before the IPO, Zepto had something like 3/4 of cash left at the current pace of spending. Roughly 9 months. So read the IPO again. This is not a victory lap. It's a refueling stop. The private capital tap is tightening, and the public capital is simply the next tank. So what does this mean for you? Even if you never buy a single share? For years, a venture capitalist in San Francisco was quietly subsidizing your convenience. The IPO moves that financing question onto the public markets. And once a company is in the index and in the mutual funds, the people funding that 79 rupee gap start to include ordinary savers, your SIP, your retirement fund, people who never opened the app. The subsidy doesn't disappear. It changes hands to the public. This is not a unique to Zepto. The whole category burns. Together, the big three players spent something like 9,000 crore in single year. The difference is the listed ones already sit on large public cash piles. Zepto still private, and it can't. Which is the one more reason this IPO is for. And this is not an optional. Now, two things the filing itself flags. It's stated plainly. The founders received summons from Enforcement Directorate over foreign investment documentation. The company says it is submitted what was asked and matter is open. And the sector faces scrutiny over deep discounting. These are disclosed risks in the document, not verdicts. Know they exist. Draw no conclusions. None of this tells you what to do. It tells you what to watch. That's the difference between investing and guessing. 5 questions the document hands you. 1. Is the loss per order shrinking faster than orders growing? That's the only arithmetic in which the total loss ever turns. 2. How much of the future profits story leans on advertising rather than groceries? And is the ad growth durable? 3. After this raise, how long is the runway? And what has to be true for this to be the last raise? 4. When the price band is finally set, is the public valuation above or below the last $7 billion private round? The market is about to give its own answer. And 5. Is the cash burn improving in absolute terms? Total rupee out the door, not just per order. 10-minute delivery is not a trick. It's a genuinely new kind of retail, but faster than almost anyone believed possible. But the speed of delivery and the speed of the profit are two different phases. The convenience arrived years ago. The economics are still on the way. And the IPO is simply the moment that second race goes public, where for the first time, the people financing the gap on every order could include you, whether you ever open the app or not. So the next time a packet of milks reaches your doorstep in 10 minutes, the interesting question is not how it got there so fast. It's who is paying for the speed and for how much longer. I will see you in the next video.